And I'm Mira.
So today we are looking at a massive stack of geopolitical reports, energy market data, and some pretty intense weekend central bank chatter.
Yeah, a lot to unpack.
Definitely. Our mission for this deep dive is really to figure out if the unstoppable force of AI can survive the immovable object of an oil-driven inflation shock.
Right, because if you look at the stock market right now, it feels like we're watching a really high-stakes tug of war.
Exactly. On one side, you have this incredibly resilient, almost gravity-defying optimism driven by AI earnings.
And then pulling hard on the opposite side is this mounting wall of macroeconomic fear.
We're talking severe physical oil shortages, soaring inflation, and, treasury yields that simply refuse to settle down.
It really is a tug of war, and today's market action perfectly reflected that tension.
For sure. Give us the rundown for Monday, May 18, 2026.
Well, it was a volatile, really mixed day across the board. The Dow actually managed to scrape by and end in the green, rising 0.32% to close at 49,686.1.
But the broader market definitely felt the pressure.
Yeah, the S&P 500 slipped slightly to 7,403.05, and the tech-heavy Nasdaq fell 0.51%.
Meanwhile, the commodities and bond markets are basically flashing red warning signs all day.
Right. Crude oil climbed back over that crucial $102 barrel mark.
And the 10-year Treasury yield spiked to 4.623%.
Those are some serious cross-currents for any portfolio to navigate.
They really are. And before we jump in, we just need to explicitly remind you, the listener, that this deep dive is for market context and discussion only. It is not personal investment advice or an investment recommendation.
Absolutely.
So with that out of the way, let's unpack exactly how we got here. Session 1. What set the stage before the U.S. session?
To truly understand today's U.S. trading, we actually have to rewind and start our timeline over the weekend.
Right, because the geopolitical baseline in the Middle East saw some severe escalations.
Highly calculated ones. Early Saturday morning at 6:22 a.m. Eastern Time, Iran's head of Parliament National Security made a major announcement.
The toll system, right?
Exactly. They stated they are preparing a ready-to-deploy toll system to control commercial traffic in the Strait of Hormuz.
Wow.
Yeah. The plan is to charge essential fees and restrict passage strictly to ships that are collaborating with Iran.
And then, just 24 hours later, on Sunday at 6:09 a.m. Eastern Time, a drone strike hit an electrical generator.
Right outside the inner perimeter of the UAE's Baraka nuclear power plant.
Which is terrifying. Plus, over the weekend, reports surfaced revealing secret Israeli military bases currently operating in Iraq's western desert.
It really complicates the regional map.
Okay, but I have to jump in here and challenge how we digest this. It's so easy for the market to look at headlines like nuclear plant drone strikes and secret desert bases and, treat them like unpredictable natural disasters.
Yeah, just random chaos.
But if we look at this through a game theoretic lens, this is geopolitical escalation as brinkmanship game theory. It isn't random.
No, it's totally calculated.
Right. Squeezing a global choke point with bureaucratic toll systems or hitting the outer perimeter of a nuclear facility instead of the reactor, that is calculated leverage designed to pressure the global economy without triggering an all-out war.
You're right to look at it as a leverage play, but the reality is that the market doesn't care about the academic theory behind the moves.
Fair point.
It only cares about the physical supply disruptions those moves create. And that brinkmanship bled right into Monday morning's incredibly chaotic news cycle.
Oh yeah, as traders were waking up, we saw completely conflicting reports about a potential U.S.-Iran truce.
Right. Iranian state media aggressively claimed the U.S. agreed to waive oil sanctions as part of a phased negotiation.
But by Monday afternoon, U.S. officials had firmly pushed back and denied any such agreement existed.
And right in the middle of that diplomatic confusion, we had former President Trump sending mixed signals on Truth Social.
Right, and we're just impartially reporting what was posted here to understand the market sentiment.
Exactly. On one hand, he claimed a deal with Iran was happening soon and they were dying to sign. But in the same breath, he stated he was fully prepared to attack Iran on a moment's notice.
Which creates a massive volatility premium in the energy markets. Traders have to price in the worst-case scenario.
Especially because the physical reality underlying all this noise is getting incredibly tight. Early Monday morning at 5:21 a.m. Eastern Time, the head of the International Energy Agency, Fatih Birol, issued a stark warning.
Right. He stated that commercial oil inventories are rapidly depleting.
Yeah, with only weeks of cover left in some key global areas. He pointed out that while strategic petroleum reserve releases have helped recently, those emergency buffers are finite and running dry.
Which brings us to the real-world economic impact. When oil spikes past $102 a barrel and inventories are draining, it functions as an energy shock, as a delayed consumer tax.
Definitely. Every logistics company, every manufacturer, every consumer, they all suddenly have less capital to spend elsewhere.
And that dynamic ruthlessly pressures corporate profit margins across the board.
And if we look at the demand side of the global economy, this delayed consumer tax is hitting right as other major economic engines are stalling out.
You're talking about the China data.
Yeah. Late Sunday evening at 9:30 p.m. Eastern Time, China reported a sweeping series of economic data misses for April. Retail sales rose a microscopic 0.2%.
Which missed global forecasts by an absolute mile.
And perhaps far more alarmingly, property investment in China plummeted 13.7% year over year.
Let's unpack that China data for a second, because a 13.7% drop in property investment isn't just a localized housing issue.
No, it's a massive global macro event.
Right. When Chinese property development collapses at that scale, you aren't just looking at unbuilt apartment complexes in Shenzhen. You're looking at a massive crater in global demand for raw materials.
Steel, copper, heavy machinery, all of it.
Exactly. It creates a vacuum that directly threatens the global industrial sector.
So to summarize the setup, as investors logged in on Monday morning, they were staring down physical oil bottlenecks, massive geopolitical risk, and a shockingly weak Chinese consumer. A real pressure cooker.
And because these global shocks didn't happen in a vacuum, we have to look at how central banks and equity markets responded. That brings us to session 2. What moved markets during U.S. trading hours?
So with that oil inflation shock firmly established, the U.S. monetary policy response came into sharp focus today.
And it translated into a very hawkish reality check.
It really did. By mid-afternoon on Monday at 3:46 p.m. Eastern Time, Chicago Fed President Austin Goolsbee delivered a blunt message to the markets.
He warned that U.S. inflation is simply too high.
Right. He noted that the job market remains highly stable and strictly warned against premature rate cuts.
Because if people have jobs and the economy is functioning, cutting rates too soon could reignite the exact inflation fires they've spent 2 years fighting.
And we really have to frame Goolsbee's hawkish comments against the structural drama that hit the Federal Reserve just before the weekend.
Oh, right. On Friday, May 15th, Jerome Powell was officially named interim chair to bridge the gap until Kevin Warsh is sworn in.
But Fed governors Bowman and Mirren took the highly unusual step of publicly objecting to that designation.
Which is crucial context, right? Because central bank credibility as an inflation anchor is paramount.
Markets absolutely crave certainty from the Fed. Having a politically charged transition and public dissent among the actual Fed governors introduces structural uncertainty.
Exactly when the market is looking for a steady hand.
Yeah.
You cannot confidently price in a rate cut if the committee making the rules is publicly fracturing.
And the market absorbed all this hawkish talk and internal Fed uncertainty by aggressively selling off bonds.
Which pushed the 10-year Treasury yield up to 4.623%, and the U.S. dollar index settled at 98.99.
We have to remember higher rates as valuation gravity.
Yes, mechanically pulling down the valuation multiples of long-duration growth stocks. The future cash flows of those massive tech companies are mathematically worth less today.
That valuation gravity is a powerful mechanical force, but it crashed headfirst into some incredible micro-resilience today.
Nvidia, right.
Yeah, at 2:14 p.m. Eastern Time, Nvidia CEO Jensen Huang gave an interview where he issued a supply warning of a completely different kind.
He warned that global demand for AI hardware is so dramatically outpacing manufacturing capacity.
Like, it will be exceptionally hard to keep up with the physical build-out over the next decade. He also notably expressed his hope that China remains an open market for AI chips.
This is where I have to push back on the broader market narrative. I mean, are we letting these macroeconomic fears blind us to the micro resilience of these specific companies?
How do you mean?
We spend so much time talking about the Fed and inflation, but we need to recognize AI capex as a cycle-agnostic arms race.
Yeah.
Buyers are absolutely desperate for compute power.
Right, they'll buy every GPU they can get regardless of what Austin Goolsbee does.
Exactly. The constraint for tech right now isn't the cost of borrowing capital. The constraint is the physical supply chain making the chips.
That's an important distinction. But bringing it back to the macro pressures, we also received critical U.S. Treasury International Capital or TIS data at 4:01 p.m. Eastern Time today.
Oh yeah, That showed Japan and China significantly reduce their U.S. debt holdings in March.
Exactly.
Walk us through the mechanics of that. Why does a report showing foreign countries selling U.S. debt from March matter for a U.S. equity trader today?
Well, because it exposes a vicious cycle regarding structural demand for U.S. debt. We know Japanese officials spent the weekend urgently monitoring their currency's extreme volatility and exploring market intervention.
Because when the Fed keeps rates high, the dollar gets stronger, which crushes the yen.
Right. And to defend the yen, Japan has to buy in the open market, and they need dollars to do that.
So they are forced to sell their U.S. Treasury bonds.
Exactly. When massive foreign central banks dump U.S. treasuries, bond prices fall, which pushes U.S. yields spike even higher. The strong dollar forces foreign selling, reinforcing the exact valuation gravity you mentioned earlier.
Wow. So to wrap up this second session, we have U.S. Treasury yields caught in a global feedback loop, acting as gravity on the broader market, while the AI arms race is violently fighting back.
Constrained purely by physical supply.
Right. So now that we understand the macro forces at play, we need to look at specific companies. That brings us to session 3. Corporate events recap and what to watch next. We talked about Nvidia's constraints, but where's all that AI hardware actually going?
It's rapidly moving out of the centralized tech bubble and into the broader traditional economy. On Monday morning at 8:12 a.m. Eastern Time, Dell announced it secured 5,000 enterprise clients for its new line of Nvidia-powered AI servers.
That's massive.
And at exactly the same time, automaker Stellantis and consulting firm Accenture announced a major AI manufacturing partnership, also powered by Nvidia hardware.
That is the pivotal shift. It proves that massive AI capital expenditure is broadening out into traditional legacy enterprises.
It's not just the hyperscalers anymore. Meanwhile, checking in on consumer discretionary resilience, on Saturday morning at 9:12 a.m. Eastern Time, Tesla quietly hiked the price of its Model Y lineup by $500 to $1,000 across the U.S. market.
That's a fascinating strategic move. Right in the middle of a global inflation shock, they are actively testing consumer demand elasticity to protect their profit margins.
Definitely a bold test of the consumer.
Well, folks, between Nvidia's chips being harder to find than a finalized Iran truce, and China's retail data looking weaker than our commercial oil inventories, it's a miracle the Dow even managed to end in the green today. At least if the Fed's Austin Goolsbee holds rates higher for longer, we might just be able to afford a barrel of that $102 crude oil with our savings account interest. Let's ring that closing bell fast before someone decides to hike rates again or another cargo ship gets seized.
Yeah, before anything else happens on the geopolitical stage, let's look at the concrete incoming catalyst for Tuesday and Wednesday so you know what to watch next.
What's on the calendar?
On Tuesday at 1 p.m. Eastern Time, we have Fed Governor Christopher Waller speaking on a highly anticipated policy panel. His remarks will be heavily scrutinized for any clues about internal Fed alignment.
Especially after the weekend drama.
Right. Then on Wednesday, we get the official FOMC minutes from the April meeting. And crucially, given the physical oil tightness we've discussed, Wednesday also brings the highly critical EIA weekly petroleum status report.
The market will be watching those inventory numbers like a hawk. All right, with the daily news wrapped up, it is time for our bonus session, paper trading.
Time to see if our daily analysis actually generates any alpha.
Exactly. We run this internal 2-minute paper trading experiment. As of today's close, our portfolio value sits at $10,959.81. Our returns are completely flat at 0.00%.
Which perfectly matches the S&P 500's 0.00% return over the exact same period. Let's see if we can break that tie.
For my trades today, I am executing a distinct pivot. I am selling 9.1% of our position in the technology sector ETF, ticker XLK, and buying a 9.1% position in the energy sector ETF, ticker XLE.
Based on the macro framework from session 1.
Exactly. We are witnessing textbook brinkmanship game theory playing out in the Strait of Hormuz. I want to actively protect the portfolio against the delayed consumer tax of this energy shock.
So rotating into energy is a direct hedge.
Yeah. And with the 10-year hitting 4.623% today, the valuation gravity on tech multiples is simply getting too heavy for my comfort. I absolutely love the long-term AI story, but I need to dodge that near-term multiple compression.
Makes sense. For my trades, I am making a slightly more nuanced rotation. I am selling 4.6% of the technology ETF, XLK. I am also selling 2.7% of the industrials ETF, XLI.
And where are you putting that capital?
I am taking the combined proceeds to buy a 3.6% position in the energy ETF, XLE, and a 3.6% position in the utilities ETF, XLU.
Walk me through the justification there.
Well, I strongly agree on the tech trim due to the valuation gravity and Taiwan geopolitical risks. But trimming industrials is a direct response to China's disastrously weak weekend data.
Right. That 13.7% drop in property investment poses a direct threat to global industrial demand.
Exactly. I want less exposure there. And buying utilities is a crucial strategic addition. We have firmly established that energy access is an AI infrastructure bottleneck. You physically cannot build these data centers without localized power generation.
Utilities are the true physical backbone of the AI boom right now. Plus, they offer defensive ballast.
Exactly.
I really like the logic behind that utilities play. So, aggregating our final decisions for execution at the May 19 market close, we will buy $700 of the energy ETF XLE. We will buy $200 of the utilities ETF XLU. We will sell $150 of the industrials ETF XLI. And we will sell $750 of the technology ETF XLK.
Sounds like a solid plan.
And to reiterate the rules of the road for this exercise, this is not financial advice. Past performance does not guarantee future returns. Do not copy these trades. This live experiment may fail at any time.
It is going to be incredibly fascinating to see how the market digests these compounding physical supply constraints as this volatile week progresses.
Let us know in the comments how you see these dueling forces playing out in your own portfolio.